I think what we're finding at the moment is a very quickly changing environment as we move out of what was a feed-in tariff scenario, which, as bankers we've been very active in for the last 15 years. What we've picked up on the last certainly 18 months or so, the market landscape is changing totally. There are still some markets where you have got feed-in tariffs, CFDs and so on. But increasingly, most markets are moving towards an element of non-contracted revenues. So what we experience at the moment is each deal that comes in is completely different to the last deal that we looked at. Each deal has far more moving parts than perhaps the last one. Intellectually, the deals now are more challenging. Downside analysis is a lot more extreme perhaps than it was previously. But it is also a far more dynamic market at the moment. So corporate PPAs clearly play a big part. Knowing the market is fundamental at the moment. Clearly we're in touch with a whole host of advisors, forecasters as to where energy prices are going, but by and large it's being as active as we can, being known as much as we can do, and then structuring our deals so that they're right for the sponsors, right for the financiers and right for the market that they're in. But it is a very dynamic environment and constantly changing, I would say. It's probably a very safe answer, but certainly at the moment it's probably more of the same. Increasingly what we see is we are being asked to take on more merchant risk each deal. Some of that we will get comfortable with and some we won't. Again, it depends on the market itself, where we see energy prices going. Other things which will come into play, a big variable for us also is storage, what impact that will have. Interconnectors will play a key role going forward as well, and it's trying to build all those in to give you as good a picture as you possibly can. What we feel also is structurally the market will change a little bit more in Europe in particular as well. Mini perms will become more popular, so sponsors can take a view along with financiers, get through construction. Then you see how merchant pricing is going for say the first 3 years, and then collectively we look at the deals again. So it's more of the same, but increasingly more dynamic. So some positives maybe. What we have seen recently is where there have been retroactive changes in, say for example, regulatory regimes across Europe. There may be less dependency on these regimes going forward, as the quid pro quo there is we're probably taking on more merchant. Regulatory risk will still be a feature. Coming out of the pandemic, governments will be scrambling around potentially, short on budget. So, additional taxes as an example could potentially occur in our view in certain markets going forward. So a lot happening really, and we all need to be well informed. I think the obvious one really is offshore wind, which again we know how much needs to be built up to 2030. So there's more chance for costs to reduce there, but the wind strengths are obviously far higher than they are for onshore wind. It will increase in prevalence across different geographies. We're already seeing that. France, Poland, the US now as well. UK and Germany will build out more. That would increase, but the mix of technologies will also increase. What we've mentioned about storage, about batteries, they will play an increasing role. Hydrogen remains to be seen a little bit at the moment, but the building blocks have been put in place for the start of that, with changes in the relevant regulatory regimes, certainly across Europe. That's probably the first step, and then over the course of the next 2 to 3 years, we'll see what development comes from that, whether it's green hydrogen, whether it's blue hydrogen, whichever way that goes. I mean, ultimately it probably will be green, but there's some time before we get to that, especially in the UK.